Last week, I talked about how the retail sector is at the epicenter of what's going on with tariffs. Walmart, the world's biggest retailer in revenue, reported earnings last week as well. No surprise, that gives us a nice window into what's happening both with Walmart and with the broader US economy as we deal with tariffs and all the countervailing winds that are out there in the economy. For today, I have 5 big takeaways. There's the 5 on Walmart's report and what that means for the broader economy and the company. Let's start with big being good. I like to invest in smaller companies, but Walmart reminded us of the strength in size when you're dealing with an uncertain economic environment. First of all, it has an international business, which accounted for 18% of its revenue last year, so not as directly affected by what's going on. It also has supply chains everywhere and has an ability to mix things around. It boasted that over 2/3 of what it sells in the United States is either made, assembled, or grown in the United States. That shelters it to some degree from what's going on with tariffs. Big companies also have more profits to deal with, more profits to move around, more profits to invest in. And Walmart said, we generally tend to come out ahead in periods of uncertainty like this one when we get through to the other side, and that we're relatively well positioned compared to our peers. The proof is in the pudding, but it makes sense that the bigger company, if it's well run, would have more room to maneuver in a time like this. We also got insight into when tariffs might start to show up in economic reports, because they haven't yet to such a large degree. And Walmart said, look, it's going to be a gradual thing. We don't expect to see an impact right away. We're already starting to see tariffs in our pricing in April and May, but it's something that will happen over time. They pointed out the big exception is with back to school, Halloween, Christmas, these events, we need to start preparing for them. You might see a more discrete boom impact because the tariffs are applied at one point when they are brought into the United States, so there's no working around that. At the same time, Walmart said that there's going to be something interesting happening because the way we account for our inventory, we may actually see an increase in profits this quarter as tariffs come into effect before we start to see that increase wind away. Walmart essentially has to value its inventory based on the prices it's selling the goods for, which could mean that it marks up its inventory, which counts as a temporary gain. That gain gets offset as Walmart pays more for its inventory over time or as prices change again. So it's not going to be a permanent thing, but it's an interesting thing as we wait to play gotcha and expect profits to go down. We may actually see a technical increase in profit because of that accounting issue. Our third point is that the economy is pretty good still, which we need to keep remembering. It entered the year on a strong foot. The soft landing looks to be in play, where inflation has come down while a recession has not happened. We haven't seen huge spikes in joblessness or unemployment and inflation, like I said. Good reports in April. Producer prices actually dropped in April, while consumer prices increased, but not greatly. Retail sales even went up in April, 0.1% from March, significant since March was when we had a big spike of pre-tariff buying. All told, the economic picture looks okay, and Walmart backed this up. They said they were seeing growth in all of their consumer segments from high income to low income. That doesn't mean that the economy is immune to what's happening with tariffs, and tariffs definitely throw a monkey wrench in the gears, but it's too early to expect things to play out, and we're starting from a strong level. So that's always worth remembering for investors as we wait to see what's happening in the months ahead. At the same time, my fourth point is there's no free lunch. There's no working around a 10% cost without any impact. Let's use Walmart as an example. We've already thrown out some numbers. Here's some back of the envelope math. If 82% of their sales are in the United States and 33%, let's say, of those sales are sourced from abroad in some way, and there's a 10% baseline tariff across the world, which it's actually higher right now because of China, but let's say we end up at 10% across the world. That will amount for Walmart to a 2.4% increase in cost of goods sold, which doesn't seem huge, but adds up to $14 billion if we use last year's sales. Walmart's profit last year was $20 billion. So that's 70% of its profits right there. Either Walmart eats those tariffs, as the president would like them to do, and investors have to eat 70% fewer profits, or Walmart passes on those tariffs to customers with higher prices. Either way, somebody's going to have to eat them. There's no magic disappearing of this 10%. Somebody will be on the hook for this, whether it's investors or consumers. We don't yet know how that's going to play out, but stay tuned for that as things come down the pike over the months ahead. And of course, my math isn't precise or exact or correct, but it's illustrative of what I think we could watch out for. Our last point that I want to make is that we're going to have the same no free lunch issue with the fiscal picture. As Walmart reported earnings, Congress is working on a budget bill for the year. We can expect it to involve lower taxes. We can expect it to involve lower spending. Tariffs is meant to help fill in for some of those taxes and to help with the deficit. But either companies are going to work around those tariffs by changing their supply chains or investing more in the United States, or prices are going to go up, or profits are going to be eaten into. And I would expect that the deficit is probably still going to be pretty high at most of those outcomes. There's no strong prediction here because economics is complicated. There are lots of different forces at play that countervail, that go into one another. But at the end of the day, math is a part of the picture. And the math suggests that if you add a 10% increase somewhere, it's going to be absorbed in some way. How that plays out in the deficit, how that plays out in our fiscal picture is to be seen. But as I record this on Monday morning, Moody's has cut the US debt rating on government debt, which has led the stock market to sell off. That's the end result to all of this, is that our debt is less valuable if we're not able to promise that we can pay it back. So that's just what we have to watch out for in all of this, that ultimately a bill will be due at some point. Again, there is no free lunch. And we'll see how these differing forces play out. Investors should continue to be on their toes and watching for what's happening. That is today's Stock Market 5, the Stock Market Thinko. My name is Daniel. Thank you for watching. You can subscribe to get more of these every week. You can check out middlecoastinvesting.com, my registered investment advisory firm. You can check out shortinvestingguide.com, where I have tons of materials on how to invest in the market. And you can stay tuned to watch this next week. Thank you for watching.